Hello all. Thank you all for joining us today. Today's webinar will be conducted by Mr. Sanjay Kumar, Senior Research Analyst at iThought. In this webinar, we will be covering a range of headings pertaining to the Indian steel sector. We will be talking about the historical performance of steel companies, the role of China in the steel sector, different variables that influence the valuation of steel companies, and the future outlook. I will now pass on the podium to Sanjay to take over. Thank you.
Thank you, Tarun. Am I audible?
Yes, sir, you're audible.
All right, perfect. Good afternoon, everyone. Welcome you all for this webinar as part of our True Blue series. Our True Blues are large cap fund. We have been doing an overview on each of the sectors within the Nifty 50, and today we'll be talking about the steel sector. Let's get started. So this is the world steel consumption and the growth rates in different time periods. If you see the beginning from between 1950 to 1970s, we saw good growth, almost high single digits of 5 to 8% CAGR. That's because the world was rebuilding after the world wars, and every economy then, Germany, Japan, Europe, US, all of them were rebuilding, and they were growing at good rates, as good as what China and India are doing today. After that, there was a lull, and then if you see 2000s again, if you see the 2000s again, there's high growth rates of high single digits. Again, that was driven by China. We'll see that in a bit. Now, the steel growth rate, the steel consumption rate, is in line with the world GDP rate of roughly about 2 to 4%. And this is India's steel capacity. If I take the last 15 to 20 years, the steel capacity has grown at a CAGR of 7%. And there were periods of high growth. As you can see, the left side of the chart, this is between 2006 to 2011-12, when the capex cycle peaked. We even grew double digits some of the years. And then the last decade was a lull period. We didn't, I think after 2013 or something, we haven't added any greenfield capacity until recently. So there was a period of 5 to 7 years where we didn't even have any greenfield capacity coming online in India. This is capacity. Consumption is no different. It's grown at a CAGR of 7%, just that it is more evenly spread than capacity, where we saw high capacity addition in some of the years. But here, the consumption has managed to grow in line with GDP of 6 to 8% roughly. So you take any year, apart from the outliers, for example, FY16 and FY20, we've had a decent or a consistent growth of 5 to anywhere from 5 to 8% in the last decade. And at the peak of the previous capex cycle, it was slightly higher at high single digit or even double digits in some of the years. So the Indian steel consumption has demonstrated an elasticity factor of 0.9 to 1.1x. What does elasticity mean? For every 1% growth in the GDP, the steel consumption also will grow at 1% or an equal rate, because the factor is 0.9 to 1.1x. So if I take data from 2000s, so FY2000 to FY23, the GDP has grown at roughly about, the real GDP has grown at roughly about 6.4%. Our finished steel consumption has grown at 7%. So if we are expecting the Indian GDP growth to continue, the current momentum to continue for the next few years, we can expect the finished steel consumption to also to be in line at 7 to 8% CAGR. But what a rational or a logical question here would be, why should steel growth grow in line with GDP? Why shouldn't it grow faster or lower? So there was a study done by the Department of Economics at Tata Services way back in 2005. It was a very interesting study. We'll see why. So this is, on the left is developed countries, and this is their steel elasticity. If GDP grows 10%, USA's steel consumption is growing only at 20% of that, as in it'll grow at 2.5%. If GDP grows 10%, USA steel consumption grew 2.5% in 2005. This is the data is from 2005. All the developed countries had elasticity less than 1, which means their steel consumption growth wasn't growing as fast as the GDP growth itself. But if you look at the developing countries on the right, almost all of them had elasticity factor more than 1, which means their steel consumption was growing at a rate faster than the GDP growth of those countries. And some were very high. For example, Thailand at 2.74, Brazil at almost 2, which means if Brazil's GDP grows by 5%, the steel consumption there will grow by 9, 10%. So that's the broad or the simplistic explanation of elasticity. So why does some developing countries have high elasticity? The answer lies in something called as the industry share as a percentage of GDP. So if you break up the GDP of any country, it is broadly classified into three. One is agri, two is services, three is industry. All your manufacturing, utility, mining, all of that will fall under the industry category. So, what was that country's industry share as a percentage of the total GDP between this 15-year period for which the study was done? So, if you look at China, they were already at a very high industry share with 42% in 1990, and it went up to 46% in 2004. Look at some other Asian countries. This is Thailand went from 37 to 44, Malaysia went from 42 to 50. Some of the developed countries saw a decline in their industry share because, excuse, the share of services was growing faster in the developed countries, whereas in the developing countries and more specifically the Asian countries, the share of industry was still high and it was still growing, and that's why their steel elasticity factor compared to GDP was more than 1. But if you look at the outlier India, the share of industry was at 28% in 1990 and it was 27% in 2004, which means our industry, we haven't gone through any industrialization phase like the other Asian countries. Another thing you'll notice is that China's elasticity is no or not very significantly different from that of India. It was only slightly above 1. But there's a reason for that because their steel consumption grew at 13.7% between this period, 1995 to 2005. So there, which means if you back calculate 1.15 steel elasticity, their GDP also grew at double digits, 10, 11, 12%. Sorry, I have a cough problem. So this low number of 1.15 doesn't mean China's steel wasn't growing, just that their GDP was growing at double digits, and hence their steel consumption also was growing at double digits, as seen in this 10-year period between 1995 to 2005. India's steel consumption in the same period grew 5%, which is what our GDP was also doing between 1995 to 2005, roughly 6 7%. So our steel consumption was only growing in line with our GDP. When will this change? See, this is data starting from 1960. This is industry share in India's GDP as a percentage of India's GDP. For a very long time, we have only that it has been ranging between 26 to 28%. In a short duration, that is between say 2003 to 2010-11, is when we saw industry share within GDP growing at a faster clip. And that's when steel companies also did well. And India's elasticity would have been higher than 1. It would have been closer to 1.5 or even closer to 1.75 during this period. Even now, this data till 2022, but if you take 2023, we'll again be somewhere around 27%. So for our elasticity to go to tend towards 1.5 or 2x, we need our industry share in the GDP to grow towards this 31% mark that we saw in the last capex cycle. Another way to look at steel consumption growth vis-a-vis GDP is to look at it from the lens of per capita consumption. Okay, if you take the total steel consumption of the country and divide it by the population, you will get the per capita steel consumption for any country. Okay, the same Department of Economics at Tata Services way back in 2005. So did the study where they found a relationship between per capita consumption and the absolute per capita income and the absolute steel consumption. So India in 2005 was around roughly around 30 40 tons per capita. If you see all the developed countries, both their per capita income was at 10,000, $20,000, somewhere between this, and hence their per capita steel consumption was also at 200 to 300 kgs per capita. Sorry, not tons, it's kgs. So each citizen in these developed countries was consuming almost 200 to 300 kgs in a year. Uh, it could take any developed country. So that's how this graph has been modeled. So as and when a country's per capita income grows and tend towards this $10,000 or $20,000 mark, their consumption also, their per capita steel consumption also will grow. But this is data for the last 10 years. Our GDP has doubled, tripled, but our per capita steel consumption hasn't even doubled. So every Indian was consuming 57 kgs in 2012. Now we are consuming 80 or 82 kgs. This is as of 2022. So as and when India's, so we are rightly at about currently at about $2,500 per capita income. As and when this improves going forward, there will be an exponential growth. So this curve is exponential. So there will be an exponential growth in India's steel consumption and per capita consumption when our per capita income tends towards the $10,000 mark. So we saw the elasticity and then we saw the relationship between consumption and the per capita income. So at a broad level, those were the drivers. But if you drill down, what are the actual demand drivers for India steel? First is automobile production, and because all your cars, two-wheelers are all made of steel. And second is your index of industrial production. And the industrial production index released by government also has many variables within that, of which two are more important. One is capital goods and the other is consumer durables. And then bank credit to commercial sector. So commercial sector borrows when they want to put up new capacities. And if you want to put up new capacities, you need steel. And then infrastructure growth, it could be driven by government, and construction sector growth, it could be driven by real estate, government, or even the private players. So these are the broad demand drivers for steel in India. So we looked at industrial production, index of industrial production. So I'll give you two graphs, one between 2004 to 2013, and the second between 2013 to 2023. You see the blue line here is industrial production, and the orange line is GDP. So during the last capex cycle, the industrial production actually grew faster than the GDP itself, which means if we go back to our elasticity factor, between this period, steel demand would have grown faster than the GDP because our elasticity factor would have been around 1.5 or 1.75. So that's driving the faster growth of steel. But move forward for the next 10 years, there's a stark divergence between GDP and industrial production. So you can argue that the GDP numbers have been purged, so on, be it whatever, there shouldn't be such a huge gap of almost 200 percentage difference between the industrial production and the GDP growth. So this, I'm not saying this gap will narrow. I'm saying this will, or even converge. It will not converge. It need not converge. But there should be some sort of uh, contraction between these two graphs in this decade, that is from 2023 to 2033, where industrial production can grow faster than GDP. It need not, but I'm just saying it can grow faster than the GDP itself. And during that period, steel will grow faster than GDP. So we are seeing the demand drivers. Next, there's one element of revenue driver where for the same sales, for the same capacity, steel companies can make more money. That is because of inflation. Let's say today, the HRC hot rolled coil price is roughly at 60,000 per kg per ton. And let's say because of inflation, some war happens somewhere, because of global factors, or even because of local factors, the steel prices shoot up. For the same capacity and for the same capital employed, steel players will make more money, and that is what is reflected in this graph also. On the left is the blue is the metal index, and the orange is the WPI, wholesale price inflation index, which indicates all your industrial products prices. Okay, so you see that the metal index tends to peak ahead of the WPI index itself. So markets are forward looking in nature, but there's a clear, even if you take a lagged correlation, there's a clear correlation between WPI index and the BSE metal index performance. This is the set of all the listed steel stocks in the BSE. So they have an index for that. So we looked at demand drivers, then revenue drivers, and within that, if you say that India's steel consumption or capacity has grown at 7%, the large companies like JSW Steel have grown faster than the industry itself. For example, JSW Steel capacity, this is just their India capacity, has grown at a CAGR of 15%. Not just capacity, you can take their sales volume data also. Even the volumes have grown at 15% CAGR in the last 20 years. I don't know how many FMCG companies can or would have shown this kind of growth in the last 20 years. And this is one of the reasons why JSW Steel has been one of the best performing large cap stocks in the last 10, 15 years. I think the last 10 years CAGR is close to 25%. So your capacity and revenue is growing at 15%. Your EBITDA and bottom line would grow slightly faster, say 18, 20%. And because of some re-rating, your shareholder, the returns to the shareholder will be higher than even the EBITDA growth. That's how the last 10-year returns CAGR for JSW Steel is somewhere around 20-25%, which is surprising. You would think that a steel company, they'll not grow in double digits and so on, but here is one company which has grown at double digits for almost major part of the last 20 years. So there's a reason for that. So take any industry, the big gets bigger and they keep getting bigger. And that's been demonstrated in the last 10, 15 years in India. You can take any industry. There's a slide put out by Spark where they keep giving this data of the incremental market share. Let's take steel, for example. Between FY10 to 17, they had some 57, 56% market share in sales volume, just the top six steel companies. Suddenly, during a down cycle, their share jumps up to 64%. So there are a lot of bankruptcies were there in the last steel down cycle. All the Bhushan companies were taken over, and many other smaller companies were taken over by JSW Steel and Tata Steel, and they got even SR was taken over by Arcelor Nippon, and that's how all the top six companies gained a higher market share. And today, if you take FY23 versus FY17, the incremental market share is much higher than their existing market share, which means they continue to gain market share. Today, it's at 92%, one of the highest across all industries. So this is JSW Steel's share amongst within the India's crude steel capacity. So in the beginning of FY6 2006, out of the 51 million tons of India steel crude steel capacity, JSW Steel had a market share of 5%. And 17, 18 years later, they have a market share of 18%. This is how they've gotten bigger over the time period. And we'll move on to the margin drivers for steel. First is raw material. So there are two aspects to the raw material itself. One is security, and two is pricing. Security is you have assured supply from your suppliers. For Tata Steel and SAIL, it's not a problem because they have 100% integrated, which means they have their own iron ore facilities from where they can take their iron ore. But someone like JSW Steel only has 41% integration in an iron ore. I'm not talking about coking coal. So some of the secondary players, so we were talking about the large players, but some of the secondary players will buy from someone like NMDC, or they'll have to buy from the open market. So that's where how I call the security aspect, where you have a consistent supply or at least have agreements with your suppliers. Two is pricing. If you're buying from the spot market, then your pricing will be linked to the global supply chain. But Indian government has put some restrictions on export of iron ore. So to that extent, the pricing is capped for the secondary players also. I mean, the impact of iron ore pricing shooting up because of global factors, that's restricted to some extent. The other major cost for steel players are power and fuel, and then employee expenses. SAIL, being a PSU, suffers because of its high, it could be legacy or it could be anything because of the unions and the high employee costs. We'll see that in a bit. So this is for JSW Steel per ton. Let's say they sold 12 million tons in FY14. The 12 million tons they have sold at an average realization of 38,200 rupees per ton. This is their realization for that year, and this is the raw material cost for them. So it's around roughly around 23,000 per ton. Power and fuel is 2,800 per ton. Employee cost is only close to 700 rupees per ton for them. So this is for JSW, and then I've given the same breakup for Tata Steel standalone. So they have Tata Steel Europe. We're not considering that. We are just looking at Tata Steel India. If you see, for the same period, FY14, Tata Steel had a higher realization of 49,000 per ton, whereas JSW had only 38,200. So does it mean Tata Steel has higher pricing power, or Tata Steel sells better quality steel than JSW? That's the advantage that Tata Steel has over JSW and even all the other players. Their raw material cost per ton is 11,400. Again, half of JSW Steel's cost. This we saw already that Tata Steel has 100% integration when it comes to iron ore. They import only coking coal, whereas JSW Steel has 41% integration and has to import both or buy iron ore and import coking coal. That's why JSW Steel's cost is 2x, raw material cost is 2x that of Tata Steel. And if I do Tata Steel minus JSW Steel for each of these line items, you will see that Tata Steel has an advantage. This is a cost, so negative is good for Tata Steel in this case. So Tata Steel has an advantage when it comes to raw material, has an advantage when it comes to power and fuel, but it loses out in employee costs and other expenses. So since these numbers are positive, it means that Tata Steel has higher expenses or higher costs than JSW Steel for these two line items. But in terms of total cost, Tata Steel has an advantage in the last 2 years. That's because of the realization that we spoke about. So, what are the risks when it comes to steel companies in India? Broadly classified it under three buckets. First is China, second is raw material, and third is competition. China is more than half of world demand today. In 2023, the world demand would have roughly been 1,800 million tons, of which China alone had, this dark blue is China. China alone had 940 million tons of steel demand in 2023, which is more than 50%. And there's a big gap between the first and the second place. Second is India, and If you see that China is almost 8 times of India when it comes to steel demand. China is at 1,000 million tons. India is roughly at 125, 130 million tons today. Third player is Japan, United States, and so on. So China being more than 50% of world steel demand, it rules or it controls the supply chain to some extent. We'll see how. So this is Spark has given the last 2023 years data for China steel. If you see in the beginning of the century, China was a net importer, which means if the number is negative, it means they were importing to match their consumption, as in their consumption was much higher than what they were producing. For example, in 2003, their production was 222 million tons, but their consumption was almost 260 million tons, which means this shortfall of 36 million tons they had to import. But what would have happened, or in any capital cycle, this is what happens when an industry is making a lot of money. Everybody goes to that industry to grab a piece of that profitability pool. And if you see, suddenly from 350, from 200, suddenly from a period of shortage, a mismatch in demand supply, they went into oversupply mode, where they added more production than what was the need. Consumption was growing at a certain rate, but production was growing at a higher rate, which meant that they became net exporters. So they are net importers and they became net exporters. This is when the real GDP growth of China was very, very good, almost double digits. But what happens when their GDP growth slows down to almost, look at this period, from almost double digits, they've come down to 7% kind of growth for a 5 year period. And this 5 year period was the worst period for global steel and specifically Indian steel players, because China was exporting a lot. At the peak of their down cycle, they exported 100 million tons of steel, which was equal to the second country's consumption. So China was exporting as much as one country, single country's demand. So we'll see what that impact was on the Indian companies because of this high exports. And towards the end of or just before COVID, the Chinese government put some environment control norms to protect their environment, to control the emissions. So their exports also stabilized at some levels, and their demand also dropped significantly. At one point, it was only 2% GDP growth. But now again, in 2023, the Chinese exports were back. It's hit a level of 90 million tons. And today, if you had to take a call on the steel sector, or at least the Indian steel sector, you'll have to take a call on where this 90 million tons will go from here. Will it go to 100 or will it go back to 80, 60? And if we drill down or double click on China's demand, we just take the last 6 years. China's real estate led demand, that is property demand, the incrementally it has lost 84 million tons. That has been made up to some extent by Chinese government infra spending. So from construction, their demand has fallen 40 million tons in the 4 year period. And machinery has grown because China, instead of exporting steel, they started exporting finished goods in the form of machinery, in the form of cars. You have seen that BYD has sold more than Tesla, or are selling as much as Tesla's selling. So they're selling more of finished goods than steel, crude steel, or finished steel. And that's reflecting in this data. So we have been saved, at least the steel in the Indian steel players have been saved to some extent because of this growth in machinery and their renewable energy growth and their auto growth. Otherwise, this full impact of the slowdown in China's real estate, in the previous slide I've shown that it started declining in 2022 and 2023. The investments in Chinese real estate, which means China would export more. So this number should have actually been 100 million tons, if not for the growth in Chinese auto, Chinese renewable energy, and Chinese machinery exports or production. So this is exports, monthly exports of China in the last 9-year period. So, so there were some production cuts because of environmental concerns, and then COVID outbreak happened. If you see, whenever the domestic demand in China has been weak, their exports have spiked. Here, the Evergrande issue happened where the real estate giant collapsed and his stock price was falling crazily. Again, the Chinese exports spiked. So this is the impact of Chinese exports on India. So this column denotes China exports, total exports, not just to India, but their global exports. So they hit a peak of 114 million tons in FY 16. And if you look at the EBITDA per ton of the top four steel players in India, that was the bottom. In fact, SAIL had a operating loss during that year. For all the other players, that was the bottom when Chinese exports peaked at 114 million tons. Again, because of FY23, it's 74. But if you look at calendar year 2023, it will be close to 90 million tons. Again, all the Indian steel players' EBITDA per ton would have taken a hit. But because we have some raw material advantage, we are not posting or any losses, but we are able to limit our impact on the EBITDA per ton, because you can see that at one point Tata Steel had 13,000 EBITDA per ton when China exports for 70 million tons. It's again 15,000 tons. So there's some improvement because of the raw material advantage we have. But if Chinese exports go back to 100 million ton, again the Indian steel players will take a EBITDA per ton hit. So there's an iron ore company called BHP, which gives their annual outlook. So they are saying that so they are not very bearish on Chinese the steel sector as a whole, because they're saying that there'll be some kind of moderation in the Chinese exports. They're giving various reasons. One is that, like we already saw, the multi-year downturn, commercial housing had shrunk appreciably in terms of its total share. So the contribution of real estate to the Chinese steel demand has been dropping from 39% a few years ago. It has now come down to 30% in 2023. So it is being a less influential swing factor in the overall balance of the Chinese steel demand. That's one reason. Two, like we said, China is now exporting more finished goods in terms of wind turbines or earth moving machinery. If you see all the metro constructions in India, you will see cranes of three players. One is there are two Chinese players, XEMG and SANY. Third is our own Action Construction ACE. So they've been exporting heavy machinery, earth moving machinery, large wind turbines. For example, Suzlon just launched its 3 megawatt turbine, but China's wind turbine players are already making 5 megawatt, 6 megawatt kind of wind turbines. So they're exporting finished goods, proper finished goods, and not just steel. So that swing factor is there. And three, they're saying that because of the authorities need to restrict demand or keep production at a certain level, they're saying that Chinese exports will not cross the 80-90 million ton mark that we saw in 2023. So they're also saying that it will not go back to the 40-60 range, but it will be somewhere in the in between these two ranges. So somewhere they're expecting it to stay. They're expecting the exports to decline, but not way below to 60 million ton level, but somewhere between 60 to 80 million ton. This is the outlook for BHP, but we don't know what China does, what they'll do, what their intentions are. If they want to screw the global supply chain, they'll just dump whatever they have in all the markets possible. Another one is price realizations. Two is uh, domestic demand. So, what happens when China exports more? One, they'll dump their material in India. Two, some of our steel players used to export their material to global countries. That will also take a hit. For example, because in 9 months FY24, we were importing more steel than exporting. So we became net importers of steel because if Tata Steel is selling at 60,000 rupees per ton hot rolled coil, and China is selling it at 50,000 rupees. Why wouldn't you buy the Chinese steel? So that's what happened in FY24, where we were importing more than we were exporting. The second risk is competition. FY21 and FY22, we saw the where the WPI index inflation shot up and the BSE metal index also shot up because for the same capacity, steel players were able to sell at a higher price. So the FY21 and 22 were very good for steel players. And last few quarters, we have seen good double-digit volume growth. The first point is about realization. Second point is about volume growth in the last few quarters in India. So both these factors meant that all the players in the sector were flush with profits and cash, and they made enough to put up capex capacity for the next cycle. So this is a risk. We'll see why. Before that, this is the numbers in the box indicate the year-on-year change in steel consumption in India. You see, for some of the months, the steel consumption growth was in mid teens, which is very good growth rates. Not many FMCG companies, even banks, some of the banks are struggling to grow at 20%, 17%, 19% year-on-year growth rates in some of these months. So this is steel capacity addition in India. You see, between FY20 to 24, we've added only 10 million tons over 5 years. But in the next 3 years itself, FY25, 26, 27, we are going to add 30 million tons. This is what a good cycle does. There was a good cycle between FY21 and 22, and there was good volume growth between FY23 and 24. All of these meant that everyone started putting up capex, and it'll bunch the capacity will bunch up together. So now we'll be adding 80, almost 18 million tons in one single year itself, compared with 10 million tons over 5 years. So this is the breakup of who is adding capacity, and so you can classify steel into flat products and long products, and all the capacity addition is happening in flat. And so, for example, if you see, so JSW Steel, they're adding 6 million tons in FY25, another 3 million tons in FY26, and so on. So what this does is the capacity utilization will take a hit. So in not just steel sector, any sector will make the best money when its capacity utilization is at the highest at an aggregate level. If you see, because of the inflation factor in FY22 and because of the volume growth in FY 22, 23, and 24 also, we were operating at very high utilization, uh, almost close to 100%. We didn't have so some companies had to restrict exports because they didn't have the capacity, and that also led to some inflation where companies preferred exports because they get higher realization there. But because of the additional capacity coming in, for example, between FY24 and FY25, just in flat, this is just for flat, 14 million tons is being added, and that is drop bringing the capacity utilization from 98% to 87%. This is assuming 8% volume growth for the next 4 years. So steel companies make a lot of money when they cross the 90% kind of threshold in capacity utilization. But because of this huge capacity addition, that's coming down below 90%. So this is one risk. Final risk is raw material. So two major raw material for steel, iron ore and coking coal. For 1 million, for every ton of steel, 1.5 to 1.7 ton of iron ore is required based on the quality, the 64%, 62%, 58%, and so on. But broadly, you'll need 1.6 ton of iron ore for every ton of steel. India is better positioned due to raw material advantage. Like I said, Tata and SAIL are 100% integrated, JSW is 41% integrated. But China imports most of its iron ore. And again, iron ore pricing, since China is a big driver of iron ore for the world, what China does impacts iron ore pricing also. Let's say China steel production falls by 5%, then the incremental iron ore requirement also falls by 70 million tons. But let's say Chinese steel production grows by 2%. That means China alone or the world itself will need 30 million tons of additional iron ore. Okay, so if China grows, iron ore price will continue to be elevated, it will start increasing. But if China degrows, iron ore prices are likely to fall. This is very likely to happen. What does this mean for Indian players? Like I said, so the large players are integrated, but the secondary players, they are not integrated. So in a falling iron ore pricing scenario, secondary players will benefit than the larger players because they buy from the spot market. Spot market prices are linked to the global supply chain. And if the global iron ore prices are falling because China is degrowing, then these secondary players will have a pricing advantage over the larger players. That's how even in iron ore, China has an impact. But so supply isn't an issue because over the next few years, by 2026 to 2027, 28, 110 million tons of iron ore supply is expected to come online. Note that a 2% growth will need 30 million tons. So even if China grows by say 3-4% by FY27, the iron ore supply chain will be kind of stable because of this incremental capacity coming online. So this is a chart of iron ore, China. If you see the post-COVID, there was hyperinflation, and then it is stabilized now, but it's roughly about $100 level. But BHP is saying that they are expecting iron ore to be in the range of 80 to $100 dollars per ton. So we can expect more decline in iron ore prices to almost 80 if what BHP is saying plays out. So this is iron ore. Next is coking coal. For every ton of steel, zero point 0.6 to zero point 0.7 ton of coking coal is required. For example, so if China has 1,000 million tons of steel capacity or demand, China will need 6.6 of that, which is 600 million tons of coking coal. Today, China imports 80% of its coking coal, and 20% is produced locally in China. India has an advantage here also because it imports from Australia while China imports from Mongolia and Russia. Post the Russia-Ukraine war, and also because China put some sanctions on Australia, they stopped importing from Australia and they started importing more from Mongolia and Russia. So the share of these two countries has gone from 50% to 80% in China's coking coal imports. But similar to iron ore, there's also some capacity coming online in coking coal. So from Australia itself. So in Australia alone, 20 million tons of coking coal projects are set to commence. This is good for India because we import from Australia, and if there is more supply coming in Australia, coking coal prices will decline to the extent or at least stay flat. So there's not a risk for India because of these capacities. This is a chart of coking coal. So if you talk to few experts, they say all of the saying that there's no way coking coal is going back below $200. So it will continue to stay anywhere between 200 to 240, $250 mark is the large expectation across industry. You see, cement also uses coking coal. So what are the valuation drivers? This is more of a summary of what we have seen till now. So in terms of volumes and in realization, the hot rolled coil price is a driving factor. That's realization. But here again, local players, West import price will determine at what price a Tata Steel or JSW Steel can sell today. There's a 5% premium in the Indian players realization. So Indian steel players are selling 5% higher than what the Chinese import prices are. So China exports, again, this is a global factor. And if the global demand falls, then Indian steel players cannot export more than they used to in the recent past. So that exports will take a hit, which is again a global factor. Iron ore price we just saw, because the secondary steel players are buying from the spot market. They're linked to the global supply chain. Again, a global factor. Coking coal, India doesn't have any capacity. Again, it's a global factor. So most of these factors are global in nature, and that's what drives steel valuations. So what could happen? China exports could stay between 80 90 million tons, or it could fall to 60 million tons. So this is a black box. But India's, uh, even if we say that China steel exports will continue to stay at 80 million ton levels, India is better positioned due to raw material advantage and brownfield expansion advantage. If you take Tata Steel, they can keep expanding in Kalinganagar or in their newly acquired plant, where they're currently at 1 million tons. In the same facility, they can go up to 10 million tons. Or you take JSW Steel, they can put 5 million tons each in Vijayanagar, in Dolvi, and in Bhushan Power and Steel, which they acquired through NCLT, which means the incremental ROCE of steel players is going to be very good in this decade. So Indian steel players have done some mistakes in the past, where they bunched up all their capex in the same time, or they went and bought a foreign company, which Tata Steel did by buying Chorus. So they've done some capital allocation mistakes in the past, which is not going to happen. They're very clear, very conscious of where they're putting up capacity. That's why Tata Steel even paid a premium to buy land as part of their acquisition recently. So if the expansion is going to be brownfield for the rest of the decade, the incremental ROCE is good for brownfield projects than greenfield projects. And India's steel demand, if you look at if you read various reports, is expected to remain strong at the 7% mark. But within that, if industry share is going to be higher than the past because of the gap that we saw in IIP with GDP. If that plays out, steel demand can grow slightly faster than GDP at say 8 9% or even 10%. So there is more risk to upside than downside if we remove China. But this if is a very big if, because we don't know what China will do. I think that's it from my side. I would love to take questions. If you have any, please drop your questions in the chat box. I'll take it one by one. Happy investing, and a standard disclaimer. Thank you. Can you please repeat this last line, incremental ROC? So today, if you want to put up a greenfield capex in India, for 1 million ton, it will roughly cost 7,000 crores or 7,500 crores roughly. This is just a thumb rule. But if you put a 1 million ton brownfield plant in India, it will cost you 5,000 crores only. So you are putting lesser capital for the same amount of capacity. For the same 1 million ton, by doing a brownfield capex, you're saying 2,000 to 2,500 crores. So you are, what is capital employed or what is ROC, return on capital employed? The denominator is what you're putting in for selling, okay, the capacity that you're adding. So if the denominator is lower, your the entire factor will be higher. That's why I'm saying the incremental ROC, if they're going to do brownfield capacity additions for the rest of the decade, the incremental ROC is going to be higher than the previous cycles. Isn't IIP vs GDP more a factor of contribution of service sector to GDP, a sector in which India is shining more? Yes, so it's a role of all three: agri, service, uh, and industry. If I look at just the share of GDP, but what we are talking about is industrial production versus GDP, which means you're right saying that services would have grown faster than industrial production. Yes, of course, but if you look at the absolute growth in industrial production, also that has been lower in the last decade. That's also down to the capital cycle, how capital cycles play out. I've done one webinar in the past on capital cycles, how when ROC peak, when margins peak, when companies have a lot of cash flow, capex, they'll put up a lot of capex, and that's how a capital cycle plays out. So, in absolute terms, also, industrial production has been weaker in the last decade compared to the previous capex cycle, that is between 2004 to which ended in somewhere in 2011. Please explain on industry PE ratio changes with Indian steel demand. Okay, so this is a very difficult question to value Indian PE companies, Indian steel companies on PE basis. The industry standard is to use price to book or in EV EBITDA. Price to book is possible if your ROE is consistent. If the standard deviation of your ROE is very high, that is, you're not able to consistently make the same ROE, then there's no point looking at price to book. So the only multiple or the right multiple relatively for steel sector would be EV EBITDA. And on average, if you take the last 10, 15-year average, the EV EBITDA multiple of all the steel players has been in single digits, 5x, 6x, 7x. They'll peak somewhere at 8, 9x. The bottom will be 4, 5x EV EBITDA. But roughly they trade at 6 to 7 times EV EBITDA. On this aspect, if we stay more on this, uh, what will make the ROE stable for these steel companies? One, we cut off from the global steel cycle, which is very difficult to happen. For that, China has to export lesser and go back to 60 million tons of exports. So that's difficult. So only when ROE becomes consistent for steel players, they'll be valued like say a cement company or a bank, and then be valued on a price to book multiple. So if we know that JSW Steel's ROE is going to be 15, 17% for the next few years, then why not give it a say 3x price to book or a 4x price to book, which is what you would give a ICICI bank. So in a short term, market might value steel companies like a bank because the stability in ROE, or the market sees visibility in stability of the ROE for the next few years because of the brownfield capex and the consistent GDP growth that we are going to see for the next few years. Then market might value it like a bank, but I don't want to give a comment on what will be the right multiple, because this is very volatile. The sector is very volatile, and if you see the data that I've given, you'll have to track multiple. So I've taken data from Bigment, I've taken from Spark. It is very difficult for an individual investor to even try to value this beast. What will be the impact on stocks like APL Apollo Tubes, which depends a lot on Tata Steel? They buy in bulk, so uh, for Tata, for APL Apollo to benefit, the realizations have to fall. For the realizations to fall in India, let's say today we are at 60,000 per ton hot rolled coil. For that to fall, China has to export more, which is bad for Tata Steel, but good for APL Apollo. So whatever we are talking about, the antithesis is good for a converter like APL Apollo, and bad for a producer like Tata Steel. Thanks for your valuable time, Gavin. Good information about steel. Thank you, sir. Thanks a lot. Any more questions, please feel free to post it in the chat box. Hi, generally in inflationary environment, what happens to commodity owners like coal mines? Okay, coal. So there are different types of coal. There is coking coal, then there is a thermal coal, which supplies to the thermal power plants in India. The Indian government doesn't allow Coal India to raise prices as it wants, or whatever it wants to even match inflation. Because if you increase coal prices, the utilities will increase the power prices, and you'll have to pay more. The consumer, the end users, which is us, we'll have to pay more for the electricity we consume. So, government doesn't want inflation from that angle, so it doesn't allow Coal India to increase prices in line with the global prices. So, even if there's a commodity inflation, a private coal mine or even the Coal India will not benefit to that extent because only I think 20% or roughly 10 to 20% of their coal output they are allowed to auction. So in the auction, if the prices shoot up in line with the global prices, to that extent, Coal India will benefit. But they'll not the remaining 80% of their production. They'll not be allowed to hike prices. Is there any forward integration coming in steel companies which will safeguard the volatility of steel prices? So within steel itself, companies are trying to increase their share of value-added products. Uh, say today JSW Steel is that I think 50% of their steel will be value-added, but forward integration is very difficult. I mean, Tata Steel is trying, like, I think they're trying to increase their downstream capacity from 5 million tons to I think 10 million. I'm not sure of the exact figure. To that extent, it will reduce, but as long as China is able to have a control on the steel prices and the steel demand and the realizations, forward integration will not help much in reducing the volatility at least. A very good question. China buying all RM from import and how their cost is less, million ton cost is less. That's because they're selling at losses. Sir. If you, I didn't have that data because that might confuse. Today, China, some of the Chinese exporters, they're not making money even at the EBITDA level. They're selling at losses because they want to uh, uh, they want to keep running their facilities and they want to keep their production up, and that's why they're selling at losses in India. At least at the EBITDA level, they're not making much money. Can you elaborate a bit more on this brownfield funda? Uh, a basic question, thanks. So brownfield is when you have an spare land already available, existing right next to your existing plant capacity. So you just extend your facility by another acre or 2 acres or few more 1,000 acres. Greenfield is where you'll have to buy the land first. So you're paying some amount for the land first, and then you'll have to put the capacity on top of it. Brownfield is where you already have the land. And we've crossed the 1 hour mark. I think we can close the webinar. Thank you all. Thank you for attending this webinar. We'll be doing these overviews of various sectors under the True Blue series. Do join for all our future webinars as well. Thank you. Thanks a lot. Happy weekend.